Barclays profits fall, hit by sluggish mortgage demand and lower income from trading. Welcome to Market Insight. I'm Ramzan Karamali. It was another busy morning of corporate results, with Barclays reporting a slightly smaller than expected 12% fall in first quarter profits. Sainsbury's underlying pre-tax profit came in ahead of guidance, and consumer goods giant Unilever saw its sales beat forecasts too. Well, to help unpack all of that and more, I'm joined by Kathleen Brooks, Research Director at XTB. Kathleen, thanks so much for joining us. Well, let's start with Barclays. Shares are higher today, but there's still a lot of pressure on the bank as it aims to save £2 billion in costs. Are investors right to be so bullish after today's results?
Well, I think so, for a couple of reasons. They have announced this strategy revamp. They did that at the beginning of this year. So it is making strides towards it. Its forecast was good, and it really shows that investment banking is back. Whilst it didn't do so well in fixed income trading, it did do very well in equities. And I think the other part of one of the lines that was really important, I think, in that report was actually the deal-making flow is higher. So when deal-making flow is higher, that means profits for banks in the future. So we're seeing that today already, and we've seen that over recent months. So we do expect that the forward guidance, I think, was quite positive from Barclays, and that's what's really driving interest in the stock today.
Now, Sainsbury's were pretty positive about their profit expectations. What's behind this optimism?
Yeah, I mean, it's really interesting because we've actually seen food price inflation fall. So food price inflation has fallen very, very sharply, and yet their profits have done well. So they're really doing very well on a lot of lines in the business. Though it was a pretty good report from them, and we are seeing that across the supermarket sector. So it is something that a bit of a trend that we're seeing, but it's certainly lifting the UK market today.
Now, consumers seem to be over the worst of the cost of living crisis, just looking at Unilever's results, which were better than expected. Is that a fair assessment?
Well, I think so. And we saw it with Reckitt Benckiser as well earlier in this week. So they are really leading the pack right now. And what's been really interesting is that, yes, we are coming towards a disinflationary process, but inflation is still incredibly high, really, relative to long-term norms. And yet, for these kind of personal care and cleaning products, for example, consumers are actually trading up into higher priced goods, so more luxury items. I think that's a really interesting dynamic. So we might have less money, or we may be paying more for things compared to what we have been in the last decade or so, but we're willing to pay for quality. And I think that is going to be very, very good for the future outlook for profits for these companies.
There was some pretty impressive results from AstraZeneca too as well. What's behind that?
So I think it's quite sad, really, but it's their cancer drugs. So we know that cancer rates are rising, sadly, in the aftermath of COVID. But they have the state-of-the-art drugs, all of this new immunotherapy. They really have registered quite a lot. They've been on an acquisition spree to get hold of these drugs, and it's really paying off. So their CEO actually got past his mega pay packet. So he's going to get 19 million on the back of these earnings. But really, there was nothing to fault them. Not only that, they've got a real strong pipeline of drugs in the future, and the gains were broad-based. There was very little to dislike in this earnings report, and AstraZeneca is leading the FTSE on Thursday.
Now, there could be quite a big deal on the table coming up. We've got BHP looking to buy Anglo-American for around $38.8 billion. Why would they want to buy Anglo-American, and at quite a premium too?
It sure is, but it's all about copper. They want to get hold of lots of copper resources as much as they could. Anglo has been in an M&A target for a little while. Obviously, it's not done particularly well. It's been involved in various scandals, and its profits haven't been fantastic. However, it has got a huge amount of copper reserves, and that's what BHP want. As they're expecting the economies to bounce back, as we're having these soft landings, particularly in the US, global growth is really in focus, and it's growing. So that's what you want for copper. The other benefit of copper is that it's really the new oil. If we're moving to a green future, you want lots of copper because it's all electrified. So that's why BHP want copper. It's a bit of a sad day for the UK index, though, let's face it, because if it does go ahead, Anglo have said that they're reviewing the offer, so I'm sure there'll be a bit of horse trading going on before anything is agreed. But it will mean that Anglo, so one of our biggest miners, will actually be leaving the FTSE 100. But whilst it's at a premium, and we have seen Anglo's share price rise very strongly on Thursday, it still is about $25 per share is what the offer from BHP is, and that's lower than what Anglo was trading at last year. So I think that could potentially be revised higher to about $30 per share.
Now, we've had some data out from the US as well. The GDP number looked pretty soft there. What's going on? We all thought the US economy was going great guns.
Yeah, maybe the American exceptionalism, maybe it's not so exceptional anymore, but it came in at 1.6% for Q1. 2.5% to 3% was about the average analyst estimate. So it is weaker than expected. But part of that drag was through lower government spending and also lower trade. Trade was a drag on the index, was a drag on GDP actually in the first quarter, and it shaved about 0.8% off of GDP. That's not actually a sign of weakness in the US economy, though. That is a sign of weakness elsewhere around the world because American exports were weak. So imports were stronger because the US consumer is stronger, but that actually negates from GDP. But we're definitely seeing maybe a leveling out. So we knew that, the US economy has been growing fantastically well certainly for the last 2 years. It looks like it's leveling out there. Even personal consumption was down. And we also saw prices rise. So maybe those price rises and that stickiness to US inflation is really starting to bite and starting to hit the consumer. So while that's bad news for stocks today, it could mean that rate cuts from the Federal Reserve are back on the table.
Kathleen Brooks, Research Director at XTB, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.